Imagine waking up on January 1st, 2026. You have $0 in assets, no stocks, no bonds, maybe a little debt and a job that barely covers your bills. The financial headlines are screaming about rising interest rates, AI replacing jobs, and housing prices that look like phone numbers. Most people freeze right here. They assume the game is rigged, so they don't even try to play. But if I had to start from absolute zero today, knowing what I know about compounding, market cycles, and human psychology, I wouldn't panic. In fact, I'd argue that starting in 2026 might actually be a cleaner entry point than we've seen in years, if you ignore the noise. What I'm about to show you isn't a get-rich-by-Tuesday strategy. It's the mathematical path to your first $100,000 and eventually your first million. And it follows 4 simple phases: the foundation, the engine, the portfolio, and the tax shield. Let's start with the foundation. Phase 1, destroy. High interest debt. If I'm starting from zero, the first thing I address isn't which stock to buy. It's the invisible anchor dragging me backward. Debt. Many people believe they can outinvest their bad habits. They'll ask if they should buy crypto or tech ETFs while carrying credit card debt at 20%. But mathematically, that makes no sense. Paying off a credit card charging 20% interest is the same as earning a guaranteed 20% return. You simply cannot find that level of guaranteed return in the stock market. Let's say you have $5,000 in credit card debt at 24% interest. If you only make minimum payments, you could end up paying nearly double that amount over time. Meanwhile, every dollar of interest you pay is a dollar that isn't compounding for your future. So if I'm starting at zero, I'm not an investor yet. I'm a debt destroyer. The strategy here is called the avalanche method. List every debt from highest interest rate to lowest. Then throw every extra dollar at the highest interest debt while paying minimums on the rest. Sell things you don't need. Cut unnecessary subscriptions. Treat it like an emergency. Once the high interest debt is gone, then, and only then, we move to phase 2. Phase 2, build a cash fortress. Many new investors make the same mistake. They pay off debt and immediately start investing everything. But life happens. Cars break down. Medical bills appear. Jobs disappear. If your money is fully invested and the market happens to be down when you need cash, you're forced to sell at a loss. And that destroys compounding. That's why before investing, you build a buffer, a cash emergency fund. Typically 3 to 6 months of living expenses. This money sits in a high-yield savings account or money market fund. It's not an investment, it's insurance. Imagine 2 investors. Investor A puts every dollar into stocks. Investor B keeps $10,000 in cash. The market drops 20%, and both investors lose their jobs. Investor A has to sell stocks at the bottom to survive. Investor B uses their emergency fund and leaves their investments untouched. When the market recovers, Investor B wins. The math favors the person who never has to sell at the wrong time. And psychologically, having a cash buffer changes how you behave. You negotiate differently. You make better decisions because you're not desperate. Once this safety net is built, we can finally move to investing. Phase 3, build the portfolio. This is where many beginners make another mistake. They try to buy a little bit of everything: crypto, gold, tech stocks, international funds. But when your portfolio is small, over-diversification doesn't protect you. It guarantees mediocrity. Instead, the simplest and most reliable strategy is index investing. Rather than trying to pick the next winning company, you buy the entire market. Historically, broad market index funds return around 8 to 10% per year over long periods. And interestingly, over 90% of professional fund managers fail to beat the market index. These are experts with teams of analysts and massive research tools. So the odds of beating them consistently as a casual investor are extremely small. Instead of trying to pick the needle in the haystack, buy the whole haystack. Funds like total market index funds allow you to do exactly that. But here's the psychological trick. Index investing is boring. It feels like nothing is happening. That boredom tempts people to gamble. So the strategy I prefer is the core satellite approach. 90% of your investments go into broad market index funds, automated, low cost, untouched. Then 10% is your fun money. If you want to buy individual stocks, crypto, or experimental investments, you use that 10%. If it fails, your financial future is safe. If it succeeds, great. But the core remains protected. Phase 4, the tax shield. Now here's something most beginners ignore: taxes. You can invest perfectly and still lose a massive portion of your wealth to taxes. That's why where your money lives matters. Instead of investing first in taxable brokerage accounts, prioritize tax-advantaged accounts. The typical order looks like this. First, contribute to your 401k up to the employer match. That's free money. Second, max out a Roth IRA. This account grows completely tax-free. If $10,000 grows into $100,000 over decades, every dollar of that growth can be withdrawn tax-free. Third, if available, use a health savings account, HSA. It offers triple tax advantages. Only after those accounts are filled should you invest in taxable brokerage accounts. This tax shield dramatically accelerates compounding over time. Phase 5. Upgrade your income engine. Finally, the most overlooked piece of the wealth equation. Income. You can only cut expenses so much, but income has no ceiling. Many people focus entirely on saving money, skipping coffee, cutting subscriptions, but you cannot budget your way to wealth on a low income. The real acceleration happens when you increase your earning power. Instead of focusing on saving $5, ask how you can earn $5,000 more. That might mean learning a high-value skill like data analysis, sales programming, project management. Investing time in skills that increase your income creates a compounding effect. A higher salary means larger investments, which means faster wealth building. Final strategy recap. So if I woke up in 2026 with $0, this would be my exact playbook. Step 1, eliminate high-interest debt. Step 2, build a 3-month emergency fund. Step 3, invest through tax-advantaged accounts. Step 4, use low-cost index funds for the majority of investments. Step 5, aggressively upgrade your skills to increase income. It's not flashy, it's not a get-rich-quick plan, but it is a proven path to long-term wealth. And over time, the simple math of compounding does the heavy lifting.